we're going to look at the units of activity depreciation method for fixed assets or property, plant, and equipment. The cost is $200,000 for the equipment. The salvage or residual value is $20,000. And the useful life is 5 years and 20,000 machine hours. Some pieces of equipment have an internal clock, so we use machine hours to track usage. If this were a vehicle, we could use miles driven. Certain machinery that produces inventory, we could even use units produced. But in this example, we're going to use machine hours. Now, I have to provide you both the total estimated hours over the life of the asset, and I have to provide you with the number of hours used each year. Okay, so notice the formula for units of activity depreciation method is cost minus salvage value, which is the same numerator as straight line depreciation, but instead of using years, we use the total estimated activity. So I'm going to put the numbers in here. Cost is $200,000 minus the salvage of $20,000 divided by 20,000 machine hours, and that's going to give us $9 of depreciation expense per machine hour. This is step one, calculating the depreciation expense per unit of activity, whether it's miles, units produced, hours, or whatever other measure a company chooses to use. Now, step two is to determine the amount of depreciation expense recorded each year. If for each hour that we use the machines, we record $9 of depreciation expense, then in year one, I'm going to simply multiply 3,500 hours, and again, I have to provide you that information, times 9. That gives me $31,000 of depreciation expense. Now, I put up a schedule here that I think you'll find very useful when doing depreciation for any method that we use. Notice we have 4 columns: beginning book value, depreciation expense for the year, accumulated depreciation, and ending book value. We'll assume that the year ends on December 31st. Beginning book value would be January 1st. Ending book value would be December 31st. Now, the beginning book value in year one, I'm going to put a little line separating this, is $200,000, which is the cost. And the reason we use cost as beginning book value in year one is because we have not yet recorded any depreciation. So cost minus accumulated depreciation of 0 equals cost. So in year one, beginning book value is cost. When I multiply the number of hours for year one that we use the machine times $9 of depreciation per hour, that gives me depreciation expense of $31,500. So in year one, my adjusting journal entry to record depreciation is debit depreciation expense $31,500, credit accumulated depreciation $31,500. You want to know that adjusting entry. Okay, and I'm also going to keep the T account for accumulated depreciation up here so you can see how it accumulates. Now remember, book value, which is the amount we have to show on the balance sheet, is cost minus accumulated depreciation. So at the end of year one, cost of 200 minus accumulated of 31,000, my ending book value is $168,500. Think about it. The end of year one, the clock strikes midnight, and all of a sudden it's the beginning of year two. So my beginning book value for year two was last year's ending book value. So $168,500. Now depreciation expense in year two, I'm going to do the same thing. I'm going to multiply it times $9, and 4,700 hours of machine use times 9 is $42,300. That's the depreciation expense that'll go on year two's income statement. So for accumulated depreciation, it accumulates, right? And so now we have $73,800 of accumulated depreciation. And remember, book value at the end of the year, cost of 200 minus accumulated of 73,800 gives us 126,200. Okay, and my lines aren't perfectly straight here, but hopefully you can go across and see them. Beginning book value for year 3, which is ending, year 2's ending book value, 126.2. I multiply the 4,800 hours of usage in year 3 times 9, and that gives me $43,200 of depreciation expense in year 3. I'm going to accumulate that. And what do we have here? 117 of accumulated in end of year 3. And my book value at the end of year 3 is $83,000. Again, cost of 200 minus accumulated of 117 equals 83. Beginning of year 4, beginning book value 83,000, 4,300 times $9 of depreciation per hour gives us $38,700 of depreciation expense for year 4. Let's add that to accumulated depreciation. And we have $155,700 of accumulated. And that gives us ending book value of $44,300, end of year 4. And that, of course, becomes beginning book value for year 5. Now, year 5, we have to be careful. Actually, the last couple of years, you simply have to be aware that you are not allowed to depreciate an asset below the salvage value. You simply have to remember that. So if we multiply 4,100 times 9, that gives us $36,900. Let's add that to accumulated. And accumulated will be $192,600, and that means my ending book value would be $7,400, which is well below the salvage value of $20,000. So I'm not allowed to do that. I cannot depreciate below salvage value, so I cannot record the full amount of the calculation that we came up with. Instead, I have to know that ending book value cannot be below salvage, in this case $20,000. That means accumulated depreciation cannot exceed $180,000. So how do I figure out the depreciation expense for the last year? I look at the difference between the accumulated depreciation here and end of year 4 and what it needs to be in year 5, and the difference looks like what? $24,300. Okay, and we could do the same thing here. The difference between the ending book value in year 4 and what the ending book value has to be at the end of year 5 so that we don't depreciate below salvage. My depreciation expense in year 5 would be $24,300, and that would mean my ending accumulated is $180. Okay, now you can still own this asset for many years after this. You simply are not allowed to record any more depreciation expense. So you have to be aware that in the last couple of years, you may run out of depreciation, and that's not a problem. Okay, so this is called the units of activity depreciation method.